Boa tarde a todos. Hoje, dia 2 de agosto, estamos começando o mês, e é sempre bom a gente começar o mês ou começar a semana ouvindo o que o Jay Pelosky tem para dizer. Hoje tem bastante coisa, coincidência que ele publicou na sexta-feira o relatório mensal. Então, quer dizer, vamos lá, vamos falar do Fed, vamos falar de tapering, o que aconteceu na China. Está realmente na hora da virada para as ações de value. So, Jay, it's great to have you again. So it's always good to talk to you at the start of a month, because that's when you publish your monthly, and you got a lot to cover this time. So let me turn to you and let's get going.
Sure, Roberto, and hello. Always great to be with Ohm Research and to do these live sessions. And yes, you're exactly right. We published our latest monthly last Friday up on the Ohm Research site titled Approaching the Turn. And I'll make maybe a couple of broad comments here at the beginning, and then I think it'd be good for us to kind of go through our global risk nexus, which is our part of our process at TPW Advisory. So we'll look at climate, economics, politics, policy, and then end up with markets. But you know, to kind of set it off, Roberto, I mean, I just continue to be very impressed by this market's ability to kind of pop little bubbles and to discount things in a very quick fashion. And over the last couple of weeks, we had a little bit of a downdraft over concerns about the Delta variant. Now, maybe 2 weeks ago, remember, we had a down Friday and a down Monday, about 3% total down S&P. And then boom, within 3 days, completely forgotten and back to new all-time highs. Last week, of course, we had the China inspired little sell-off where some of the uncertainty around China spread into the U.S. tech names. And yet, lo and behold, again, we go back and we reach new highs. And so to me, this is something that we have to respect. We're dealing with a very strong, in my view, equity bull market. I call it a pothole market. As you remember, we've talked about this many times. The market's going fine. It has a little downdraft, but it's like you're driving a car down the road, down the highway outside of Sao Paulo, and you hit a pothole. Yeah. You get a little bit concerned, but a mile down the road, you've completely forgotten about it. And B of A actually did some interesting work showing that the recovery time from big down days in the S&P is as short as it's been at any point in the last 100 years. So that just kind of supports analytically this idea of a pothole market. And so for me, there's the tactical issue and then the strategic issue. So tactically, the focus continues to be on the contest between the Delta variant spread in the vaccine production and vaccination surge. And the Delta variant spread gets all the attention, all the headlines. Even today, it served to kind of set the market back after a strong open. But interestingly, all it did today was just kind of cap the upside, as opposed to 2 weeks ago, it was taking us lower. And so I think the Delta variant is going to lose out to the vaccine production and vaccination surge. I would note that 70% of US adults and 70% of European adults have already gotten at least one shot. And the bulk of China.
The US reached the mark today, I just saw.
Yep, exactly. And Europe beat the US, which, 2 months ago, you would have never thought would be the case. Yeah. And so and China is making news because it has a couple of hundred cases, but it's nothing like prior periods. And so to me, when you add together China, US, and Europe, you have the vast bulk of the global economy, and it's pretty well protected. The other point about Delta is that the life cycle is very short. And so it typically is about 50 days. And we've seen that in India. We've seen that in Scotland, in the UK, and I think we'll see it in the US as well. In other words, by the time you kind of get worried about it, and every day now there are headlines about mask wearing and things of that nature in the US and elsewhere, but by the time we really get worried about it, I think the Delta variant is going to already have cut through the population and will have moved on. So that's the tactical issue. The strategic issue continues to be the shift from a staggered reopening to a synchronized global expansion. And I believe that we're getting ready to manifest that. And when we do that, that's what's going to kick off the turn. So when I say approaching the turn in the title, the turn is away from growth stocks, away from the U.S. equity focus, to cyclical and value segments of the U.S. equity market in non-U.S. markets, which have more cyclicality to them, particularly in the developed economies like Europe and Japan, as well as the commodity sector and markets that are exposed to commodities like parts of Latin America, Brazil, et cetera. And so that's what I mean when I say approaching the turn. I think we're very close. Just to give you a couple of data points, one we all know about, which is the extremely low level of U.S. Rates, nominal rates, but also real rates. Real rates in the United States are as low as they've been at any point in the last 50 years. And then secondly, the focus should be on understanding that U.S. growth stocks are the stocks that rise, and I have this chart in my monthly, stocks that go up when U.S. Treasury prices go up are at their most expensive versus the relative market at any point in the last 50 years. So I think we're very close to this turn, and I think the opportunity set is quite attractive with segments of the cyclical and value components having already had pretty big, healthy corrections. I just note XLE, the energy ETF in the U.S., is off 16% from its high of a couple months ago. So you have opportunities like that throughout the cyclical and value space.
Yeah, and given that you started by mentioning XLE, and I remember you mentioned quite a few times that you can play both, old and new energy, or let's say clean and not so clean energy. So, what's your stance on the ICLN? I mean, it's done well last year, but it's off, I would say 25, maybe 30% off its highs. Is now a good entry point? And is there a preferred one? I mean, which one is more interesting now, ICLN or XLE?
Yeah, it's a great question, and I continue to think that that opportunity set still applies. In other words, the ability to make money in the fossil fuel space, in part because as demand picks up, the supply is going to be somewhat challenged. Not as much in oil as in some of the minerals, but I think it still is valid for the oil space. And then, as you mentioned, the clean energy space, not so much ICLN. We've been out of that for several months in our model portfolios, but I continue to like the clean energy space and things like LIT with the batteries, carbon, KRBN remain a thing very attractive to us, and we continue to hold them in our model portfolios. And so I think that basic thesis that you're going to be able to invest and be successful in both fossil fuel and minerals because of a lot of different reasons, supply, demand, ESG related financing limits, et cetera, and the new energy where, as we'll touch on, it's actually a pretty good segue into the first part of our global risk nexus, which is climate. I continue to feel that climate is the single biggest global macro trend for the 2020s. Investors have to understand it, have to learn and appreciate how to invest in it. And I think the thematic space and the ETF space and the ETF instrument is definitely the way to go. And so I would just make a couple of points about climate. First, clearly it is extreme weather events are becoming visible all around the world at the same time. So I think it's fair to say there's probably not been a period in recent history where more of the world is focused on the idea of extreme weather and climate change. And I think this is important because that personal involvement drives political engagement. That political engagement drives policy change. That policy change creates investment opportunities. And that is the way I think investors should think about it, just like that. And so in addition to the kind of in-your-face visible nature of the extreme weather events that we've had, again, globally, there's also been a lot of action in the last month or so. And I highlight in the monthly two specifics. One is Europe going through its first major adjustment to its climate plan in the 16 years that it's been in place, particularly their carbon emissions trading system, or ETS, That's something we're very focused on through our carbon investment focus. And then secondly, China implementing its national ETS system. They've had regional ETS programs, but they've now unified it. And I would just make the point, or when we finish, and then I'll make the point. Yeah. The third is that the U.S. is now talking positively about potential carbon tax and a potential carbon border adjustment mechanism, or CBAM. Europe is the leader here. The U.S., for the first time ever, this has never been something that political people in the U.S. have talked about. So this is new stuff. For the first time, it's becoming a talking point in Democratic circles as they look for ways to pay for the Biden infrastructure plan. But the thinking here is, Roberto, is that there's a possibility that the Europeans and the U.S. could come together and do a joint CBAM, which would really hit China very, very hard. And so I think one of the reasons why China is moving aggressively on climate is because they understand that they are exposed both politically and economically to not having priced carbon correctly within their own system. And just to put a data point on that, carbon in the new trading in China's new system is trading at about $7 a ton. In California, in the U.S., California is the biggest ETS component in the U.S. Carbon is trading at about $20 a ton. And in Europe, it's about $55 a ton. Yeah. So the Chinese, I think, are waking up to the fact that their pollution issue, which they've been trying to deal with for years because it was just unpalatable, is rapidly becoming a geopolitical and geoeconomic pain point for them.
No, I agree, and this is extremely important that China does not get away with it anymore, and there's not the so-called carbon leakage. So I mean, if you cannot pollute in Europe and you will not be, or in the U.S., you won't simply be able to shift production to China, and everything will be fine. So I think it's of course very very welcome. And talking about China. You kind of touched on this before, but you mentioned on the crackdown on their tech. It's mostly ed tech stocks, and you wrote in the monthly that it looks like this may be over because they don't want to they don't want to destroy their capital markets, and especially Hong Kong, which is where they have their the Hong Kong dollar is China's reserve currency for now, and that's where they, the main listing, their main capital market. So, I mean, you share that view. Do you think this is over, and we could be looking for a recovery in Chinese tech stocks?
It's interesting. I mean, you're jumping ahead a little bit, but we'll go there. We'll touch on the politics because that's where I kind of place this in the GRN, in the political section. We'll go back and hit the economics after this, but obviously top of mind for investors. And it's funny. I was on Bloomberg TV and radio last Monday, a week ago tonight, and for the Daybreak Asia show. And so naturally, this was all because last Monday was when all this kind of went off in terms of really impacting the U.S. markets. And I said then that I thought people selling would be making a mistake. And it was simply a matter of looking at the technicals and looking at the volumes traded. And in the U.S. on Monday, the volumes on some of these Chinese ETFs were 8 or 10 times the average daily volume. And the RSI, the short-term RSI, was under 20. And so that's all you really need to know, that at least from that perspective, they were oversold. And I think this makes a bigger point, which is that given that we're in an ahistorical period in terms of, sudden stop to the global economy and then a reopening, never been through any of this, right? You look at the fiscal deficits, haven't seen anything like this since the 40s and World War II. So in this ahistorical period, I believe technical analysis is very important for investors because, look, both men and machines can follow the technical levels. And day-to-day trading is increasingly done by machines and on algorithms. Yep. And so I think it really is important. And I personally am spending more time than I ever have looking at the technicals across the positions we have in our two model portfolios. And it really helps. And it helped on Monday a week ago, because it was clear, just looking at some of the things like short-term RSIs and trading volumes and things of that nature, that the China ETFs were massively oversold. So that I said on Monday, and included that actually in the monthly that's up on the OHM site, that Bloomberg clip is included there. But more importantly, where do we go from here? I think that the lows from a market perspective have probably been realized. I think there are probably going to be continued government discussions and clarifications and maybe more additional edicts on these subjects, because it's important to note that China doesn't run its economy on what U.S. and Western investors want to see happen, right? They are focused on building socialism with Chinese characteristics, and these issues, whether it's fintech and antitrust, whether it's data security with DD, or whether it's social equality with the ed tech companies, all these things are meant to make it easier to have families in China so they can deal with their demographics, make it easier to control their own technology, and shift the focus away from software to hardware. This is another key point that hasn't really gotten as much attention as it should. Most of the fintech stuff and the payment stuff is all social media driven. And China is very focused on trying to reduce its hardware deficit with, let's say, the West, right? Because they still get the bulk of their semiconductor chips from the West and from Taiwan. So there's a very big focus on shifting some of that intellectual capital away from stuff like social media to things like, okay, how do we develop AI? How do we develop our semiconductor capacity? How do we protect ourselves against things like the Huawei situation a couple of years ago with the US? We've made it very clear in the West that China cannot depend on the US, and to a lesser extent on Europe, for key components in its technological development. So they are focused on making them themselves. And so that's part of the issue with the focus on social media. The data stuff, we talked about it a year and a half ago in our Tripolar World 3.0 update, when we coined the term splinternet and talked about how technology was going to be a driver to the development of the tripolar world. And here we are a year and a half later, everybody wants their own semiconductor plant. Europe, US, China. Everybody wants their own battery production capacity. Europe, US, China. And so the tripolar world, which is the framework for the way I think about the world and have been thinking about this for over a decade, is manifesting itself, right as we speak. And then the last point is this idea of social equality. Look, I have two high school kids, and we've talked about this, right? You and I both have talked about this. We have high school kids, and I'm in private school in New York. I know all about the arms race of tutoring, all about it. It's horrible. And I can only imagine what it's like in Shanghai, in Beijing, and other places in China. So the thing for us as investors to remember is that these are popular measures in China. These are popular measures. This is the Communist Party showing its people that it's not going to allow inequality to get worse. And so they have the saying in China, you kill a chicken to scare the monkeys. Right, so a couple of chickens have been killed, and now everybody else is going to get in line. I think the last point I would mention is one also important, is that, look, China is focused on its dual circulation strategy, right? One circulation is the external, export, etc. The other is domestic consumption. And China wants to, needs to, and should grow its domestic consumption. And in the advanced economies in the US and in Europe, consumption is 65 to 75% of GDP. In China, it's about 45 to 50% of GDP. They need to get that up. One way to get that up is to make sure that, hey, the delivery people get paid a decent wage. make sure the middle class family in Shanghai who has 2 kids, maybe thinking about having a third, doesn't have to worry about paying exorbitant tutoring fees to give their kid a shot at doing well in life. So these things are probably going to continue. The bulk of the market impact, I believe, has already been felt. And the idea that China is going to devalue its currency and collapse its financial market, I think is, doesn't make any sense at all. China wants and needs financial stability. The bigger issue is probably on the fixed income side with some of the heavily indebted developers. That's probably where we should really be paying attention. That's at least where I am paying attention, not so much what's happening with some of the edicts coming out of the government.
Yeah, no, that's this is great. So now, I mean, should we move on to economics? I mean, this week we saw. I mean, today actually, the PMIs in Europe, they are still surprising. They are still, blowing away at expectations. And in the U.S., I mean, it clearly looks like things have peaked. They're still, and I want to go back to what you said last time, which is that investors struggle to deal with the idea of peak growth. They think sometimes we're going to go to negative growth. So can you first talk about Europe and the idea that the economy is accelerating because that's the signals you get from everywhere, and then the U.S. PMI and the idea of peak growth, because right after the PMI today, the U.S. Treasury went to 118. So and it is still quite decent growth. So what should investors make of it?
Yeah, no, it's a great question, and you're absolutely right. And I appreciate you remembering our comments from last week, because this, again, has been something that we've been talking about here in these live sessions, and why clients and interested investors should be participating here, because this is not new to us. We've talked about this for several weeks in a row already. And, we have to continue to talk about it. And I'd say, look, the first point is that the bulk of the global economy is walled off from COVID. Okay, with 70% of US and European adults having had at least one shot. In the bulk of China, COVID is not an issue at all. That's the important point. And I believe that the vaccination surge, which is now Delta is being the best force for getting people to vaccinate in the US at least than anything else. The US is vaccinating more people now over the last week than it has in months. So that's also good news. Now, on to the economy. Look, we've talked for a year practically now about COVID speed, first in, first out, follow the leader. China was first in, first out, came out, their peak growth was in Q1, year-over-year peak growth. Q2, there was still good quarter-over-quarter growth, and this is the distinction investors need to understand. Peak growth year-over-year does not mean that's the end of growth. China shows that. The U.S. is going to show that, right? U.S. peak growth was probably Q2. The data just came out. It was disappointing. Why? In large part because of inventory issues and supply issues. Demand was very strong. And so that suggests that Q3 is going to be quite strong for the U.S. as well. And you and I tweeted back and forth. Somebody put out something saying that the big risk is that second half 2021 growth in the U.S. is going to be, second half 2022, sorry, is going to be 1.5% to 2%. And if that's the case, and I think consensus right now is about 2.5% for the second half of 2022. So I think the risk is to the upside on that, not the downside. But the question is, what happens after peak growth? And the issue is, I believe it's going to be normalization, not move right to late cycle, right? And because, again, COVID speed, we had the shortest recession on record, right? The COVID recession was 2 months, 2 months. So we're now in year one of a global economic recovery. And by the way, G7 economic expansions tend to last on average 5 years, okay? So we're in year one. Even if it's a shorter cycle because of COVID speed, it's highly unlikely to be over in the next 6 months. So I think that's another point for people to importantly to keep in mind. And then the third is your point about Europe, and I would add Japan in there as well. Europe is behind the US, so its peak growth year over year is probably coming up in the second half of the year. Q2 growth in Europe was better than expected, significantly better than expected.
Yeah, way better, yeah.
German retail sales just came out today, considerably better than expected. So again, notwithstanding all the Delta talk and worries about lockdowns, manufacturing PMIs are still very solid. And the service sector remains relatively robust because we've kind of figured out how to work around a lot of the uncertainties. And my bet is that in the coming weeks, and certainly the coming month or two, Delta is going to become less of an issue. And we're going to realize that, wow, there's no real impediment anymore to kind of open-ended growth and that synchronized global expansion as Europe recovers, as Japan recovers, as the EM recover. And that's what's going to be the trigger, as I said, to the turn back to the more of the rotation or reflation trade with the cyclical and value and non-US starting to perform. So I think, even in Japan in the last couple of days has had better than expected industrial production, better than expected retail sales, and had consumer confidence numbers come out today that were the highest in 17 months, even amid and all the angst and uncertainty and negativity around Tokyo and Japan and their vaccination and their COVID response. Best consumer confidence in 17 months. I think one of the big opportunities in global markets today is Japanese equities.
Yeah. Well, and going to the U.S., there was also when you said, we tweeted back and forth about productivity growth, because I think there was a Bloomberg article or Financial Times article, I don't know, and then I mentioned you and then retweeted, which mentions the capex boom that you talked about, and also a lot of the how COVID has accelerate with COVID speed, the early adoption of a lot of technology. Mm-hmm. So if you want to add a little bit more on this, on
sure.
How this may be kind of we're not going back just to trend growth. We may stay for a while above trend growth.
Yeah, I think that's an excellent point, because we hear so much about end of cycle, late cycle, all this concern, all this risk, all these worries. Nobody talks about the potential for better than expected growth, right? For above trend growth. And look, the setup is there. The setup consists of three things. The first is the pro-cyclical spending of the Biden administration. This is where the infrastructure package is so important. And it looks like the hardest part of it, the bipartisan part, has been done, right? The big human capital part, the $3 trillion price tag, is going to be passed via reconciliation, not going to be requiring Republican votes. So the hardest part of the infrastructure dual track approach looks like it has been achieved on time. And again, this reflects the fact that Biden is a Senate guy. He was in the Senate for 30 plus years. He knows how to work the process. He knows how to work the system. Unlike President Trump, because there's been a lot of talk in the U.S. about why Biden's been successful with infrastructure and Trump wasn't, even though Trump talked a lot about doing an infrastructure deal. Nothing ever happened because he was not a political guy. He didn't know how, and nor did his team really know how to work the halls of power, let's say. Some people thought that was great. If you wanted an infrastructure plan, you're way better with somebody like a Biden and their team getting it done. So that's first, pro-cyclical spending. And by the way, it's happening in Europe too, right? A lot of talk about Germany and the potential for the Greens to join the coalition with a focus on removing the debt brake there in Germany and letting fiscal spending continue to run. Some interesting stuff over the weekend with the European Minister of Finance saying the same thing. They need to update their fiscal guidelines to allow for pro-cyclical spending. So this is not just a U.S. issue. So pro-cyclical spending, CapEx boom, which you touched on, right? People need to understand that CapEx, both public and private, as a percentage of GDP in the United States, is at a 30 to 40-year low. We are in massive deficit for our spending on CapEx. And so I think climate is going to help drive that, right? So climate assures that we're going to have big government or government playing a bigger role in the next decade than it has in the last 30 or 40 years, at least in the United States. Again, important point to have people understand how this is all dovetailing together. Pro-cyclical spending, CapEx boom driven by climate. And then the third is this productivity surge. And Goldman has shown data that suggests that the productivity growth in the US has doubled pre-COVID to post-COVID. And then there's a lot of work done by the guys at MIT and elsewhere who are the real productivity gurus, saying that this acceleration of COVID means that a lot of the technology that has been developed over the last decade is really solidifying and going to be driving things going forward. So there's a reasonable chance that instead of worrying about 1.5% growth, let's call it trend growth in the US pre-COVID 2%. There's a lot that says one could think about above trend 3% growth in the next couple of years, driven by the things we just talked about, which is not really in anybody's wheelhouse at the moment, because it's so much easier to talk about why things are not going to work as opposed to why things might work.
No, and this is fantastic, and I agree. Just finishing off on Europe, I mean, it looks like really the economy is accelerating. You have the infrastructure plan, and also something that you talked about is financials in Europe, where you're very optimistic, and we're starting to see some consolidation. And even banks like Deutsche Bank have reported good numbers, but finally they're going to deal with Monte Paschi in Italy, which is the oldest bank in the world, going back to the 14th century, but it's also the most troubled. It required I don't know how many billions of euros in bailout. So but then another thing I wanted to add is, and which you also talked about in the monthly, is the earnings season, which again blew away at anybody's expectations. If I'm not wrong, I think in the US was over 90% of companies reported above estimate, both sales and earnings. And if I'm not wrong, the average is like 20%. And I mean, what does that tell you? And I also want to recall what we discussed in the last conference. And I remember you saying that the market normally underestimates EPS when there is strong fiscal stimulus and we're coming out of a strong recession. So it looks like there'll be a lot of upgrades over the next weeks. And how do you reconcile these things?
Yeah, no, I think again, spot on with the question. Earnings have been powerful, have been strong. They're going to continue to be strong. No real surprise. I think the focus, as I mentioned a couple of weeks ago in my musings, the focus should be on forward looking, right? What are companies saying about the second half? What are companies saying about 2022? And there, importantly, analysts are upgrading their earnings expectations for the quarters ahead. And that's really the important point. Everyone knows earnings were going to be great because you're comparing against the trough in COVID a year ago. And the other thing I'd mention is that earnings have also been great in Europe and in Japan. Again, this is not a US issue. This is a global issue. Earnings in Europe are blowing away the expectations. Earnings in Japan blowing away. Again, notwithstanding all the negative headlines, notwithstanding all the COVID fears, earnings are much, much better than expected across the globe. And this is the type of thing that makes one understand why the market remains so strong. Very hard to see a market going down big when earnings are beating expectations, when earnings revisions are being increased, and when the opportunity set has potential upside that we've talked about, and big parts of the market have already corrected fairly significantly, as small caps have, as the cyclical and value segments have. These have already corrected. And so it's not as if the whole market, there's a lot of talk about breadth divergences and the fact that the equity market, at least the S&P, is at all-time highs on very small number of stocks. That's absolutely correct. But what that says is that there's a whole host of the market, a whole segment, multiple parts of the market that have already had their correction. And we need to see those interest rates go up. And I'd be, as I said in one of my pieces, I'd be lying if I told you I knew exactly what's going on in the bond market. But I do think I do think, much smarter people than me are trying to figure it out. So hopefully they will, and they can tell me, and we can go forward. But I think that rates are the thing that doesn't really jive with where I think we are in the cycle, where we are in the economic reopening, where we are in the synchronized global expansion. Gold is not validating the real yield level, for example. Copper is not validating the interest rate level that we're at. So you can tote up a number of things that suggest that that we're not that far away. And maybe it's going to be the tapering that kind of sends a signal to bonds that they're mispriced. But I think at some point it might be the jobs number this Friday. If we get a really whopping jobs number, and people are saying, could be 1 million jobs. If we get a big jobs number, once infrastructure is passed, once tapering is done, I mean, there are a number of potential catalysts out there. But earnings, last point on earnings is that JP Morgan and others are now talking about $230 for 2022. That puts the S&P right now at 19 times earnings, forward earnings. That is expensive, but it's definitely not outrageous. And by the way, the segments that are going to really drive earnings in the next, we had this chart in the monthly, actually came from our friends at KKR. The segments that are going to drive earnings over the next year are the cyclical segments. And again, not only in the US, but also in Europe. JP Morgan does a really nice job breaking out the cyclical earnings power in Europe versus the price action. And so while cyclicals are generating the earnings power, they're not getting the love in terms of their stock prices going up. So that, again, is creating the opportunity. There's a big part of the market that is ready to roll. And as I said, that's why more and more as I sat to write the monthly, it just struck me that there are a number of these data points that argue that we're approaching the turn. And, that's exactly why I titled the piece what I titled.
Yeah, we talked a lot about the U.S. Treasury, and you were spot on when you said, it's now 2 months when you talked about your bear case, which was just the U.S. Treasury yield coming down. Maybe some people know how much of that is yield searching and how much is a growth scare. So we got a growth scare. A lot of that was the Delta variant, but now the Delta variant disappeared, and we have the infrastructure bill finally passed. So it doesn't really look like we have any more overhangs, and why people should be scared about growth. So can you comment a bit on this, and also additional comments on the infrastructure bill? What's the timing of the passage, and then the human capital bill?
Okay. I'm just trying to. You asked about three things there, Roberto. You're testing me. It's 5 o'clock on a Monday. Okay, so I guess the second phase of the infrastructure, we'll start at the end and work forward. The second phase of the infrastructure plan is probably not going to be discussed until after the summer recess. So that's probably going to be a fall activity for Congress. The bipartisan part that has been kind of agreed upon, I think is going to is going to be, I believe, passed by the Senate most likely in the next couple of days. The House is already on recess So they're not going to do anything. They'll pick it up again when they come back after recess. So these things are kind of still out there, I guess, as potential catalysts. But I would make the point that, you know, there's always these market kind of sayings, right? And, you know, the saying, sell in May and go away, right? A lot of talk after the strong start to the year about sell in May and go away. Has been completely wrong so far, right? If you look back from the end of May till today, equity's up, I think 1.5% to 2%. S&P's up 4%. So clearly, you would have left a lot on the table. The other, you know, saying that's certainly making the rounds now is about the poor seasonality of the August and September timeframe, and you know, everybody's talking about poor seasonality. And so, to me, I think that's a little too simplistic. And it may be, I think a lot of people got defensive. I like, there's a guy who writes the Macro Tourist, Kevin Muir. He's a Canadian guy. And he wrote a piece over the weekend talking about how every professional guy that he knows is cautious to bearish. And while they talk about sentiment being overly bullish, virtually all the professionals are very cautious. And you even see that with Morgan Stanley. Morgan Stanley came out with work over the weekend saying that hedge fund gross exposure to Europe is in the bottom 20 percentile of the last 10 years. Bottom 20 percentile gross exposure to European equities by U.S. and European hedge funds. So the idea, I think, pain trade, you know, another common phrase on Wall Street is the pain trade. I think the pain trade here is clearly that stocks go higher. And I think we got a little taste of it this morning. The open this morning was pretty strong. Markets wanted to go higher. And then you had, as you pointed out, a little bit of a disappointment in the PMI. Bonds rallied 6 or 7 basis points, and poof, it all kind of went away. But we still ended up. And so I think the, you know, to me, the upside opportunity is pretty good. The idea that poor seasonality is why we should stay out of the market for August and September, I think could prove to be a mistake. Just as sell in May and go away has proven to be a mistake. And so for me, I think we're setting up for that turn, and investors should be looking at those parts of the market we've already spoken about and markets that we've already discussed as places to perhaps put some money to work.
No, that's fantastic. And, you know, we also mentioned, you know, the jobs report that can be, you know, another potential catalyst for, you know, for move higher, especially in rates. Given that given that you pointed well that, you know, rates and equities, I mean, the yields and equities now move in tandem. Is it the case that we could be looking for another million jobs number on Friday?
Yeah, I mean, I think the consensus is like 890 or something, but the whisper number, some people are talking about 1 million jobs. I mean, I think that's more, you know, kind of a big round figure type of an approach. But I do think that the market is, you know, clearly bonds are unprepared for any sign of strength. I made the point that, you know, stocks that are anti-correlated to U.S. Treasuries, right? So when the U.S. Treasury price goes up, yields go down, these stocks go down. They are the least expensive versus the broad market they've ever been. I'll give you a couple other illustrations. XLE, I think I mentioned it earlier, off 15% from its high. Doesn't fit at all with the oil price. Let's remember the oil price is up over the last couple months. Stocks are not. There was the biggest outflow in U.S. value ETFs in July that I think it was a record. So you had massive selling of the value space in July. So it's perfect. You know, the setup is perfect. You have all these things. You have treasuries at 1.18. You have growth stocks as expensive as they've been in 50 years. You have value stocks as cheap as they've been in 50 years. You have record outflows of U.S. value ETFs. You have potential for a jobs number. You have potential for further movement on the infrastructure side. You have potential for the Delta variant to kind of dissipate as a concern. You have multiple possible catalysts. I think you have continued very strong earnings growth. So to me, as I said, I think this has been a twin engine market. When rates go up, cyclicals and values do well. When rates go down, growth does well. That's why the market's been able to absorb all the bad news and have these little potholes, but then keep marching higher. The Delta variant's probably the last, thank goodness, and let's hope it stays this way. There is no real other variant after the Delta variant that is scaring people. So as we continue to inoculate people, as that vaccine production surge, remember, 6 billion doses to be manufactured in the US and Europe in the second half of this year. 5 billion of those available for export. 33 million shots per day globally. The entire world can be 75% of the adult global population can be vaccinated within the next 8 months by the end of Q1 next year at the current pace. So my sense is that we are getting much closer to the end of COVID being a market moving factor than we are at the beginning. And once we move away from that, we can focus on the fact that second half growth this year in the US is going to be 5%. Europe is going to grow at 4.5% to 5% this year and next year. Japan is coming up behind us. Emerging markets after that. Earnings growth robust. To me, it's we continue to be overweight equities. We continue to be massively underweight fixed income, especially government. We are significantly overweight commodities across the space, from fossil fuels to industrial metals to precious metals to clean energy to carbon. We continue to be very involved thematically, continue to think the thematics have held up very well over the last couple of months. And I would be very remiss, Roberto, if we didn't mention Bitcoin and the fact that it had a 45% up move in 2 weeks and absolutely nobody said anything about it. I mean, can you think of anything more bullish than a 45% up move and no attention paid whatsoever? So to me, there is, we remain constructive. I think it's too simplistic to simply say, poor seasonality and let me, stay out of the markets here. I think there's a lot of segments that have sold off that are attractively valued, that are technically sound, and that are prepared as soon as rates start going back up, and we've laid out a number of potential catalysts to have that happen. The rotation is going to be violent. I suggest you start positioning for that now rather than waiting for that moment to come.
Yeah, and another thing that you mentioned, which I think, of course, it has to do with rotation, is the dollar. So, I think the dollar has been a clear winner this year. Every time, there was, there was surprise, with the Fed and everything. And then even despite, the dovish talk later on, the dollar has held up quite well. So, in the beginning of the year, there was, the consensus, the overwhelming consensus for the dollar to depreciate. But then, there was a surprise of the Democrat victory. So where do you stand on the dollar now? I think you mentioned on the monthly that, once we have more spending kicking in and paradoxically, if U.S. yields go up, that could be negative for the dollar because that means, accelerating, global growth, based on fiscal spending. So what's your take there?
I've been kind of a dollar bear, but not, a growling one all year. Kind of thinking that when we get that, the dollar case for the first half of the year was that the U.S. was exceptional, both in terms of fiscal stimulus and vaccination process. Those two things are ebbing. And as we move into a synchronized global expansion, I think the focus should shift to the cost of that exceptionalism, particularly in terms of the twin deficits. And I showed again a chart in the monthly showing historically when you have big deficits like that, the dollar goes down. I think right now the dollar gets a safety bid. Treasury is the only, major government bond that has positive yield, right? The German bond at minus 45 bips and the JGB at, 1 bip. And, the CGB, the Chinese government bond, does a higher yield, but is still not fully embraced by fixed income investors globally. So, I think that's been a big part of it. The other point I would mention now, kind of currently, is that you have other central banks, particularly in EM, raising rates, and so kind of the Fed is no longer the most hawkish central bank out there, and that too may support some of these other currencies, particularly countries like Brazil, Mexico, elsewhere, that are raising rates in part to deal with inflation and in part perhaps to get ahead of potential taper risk. So I think the taper fear, kind of for EM is definitely much reduced from where it was in 2013. And so the way we've been playing it in terms of the dollar is I do think that the dollar has downside. I mean, even technically and kind of just looking at it, it did not break out here when it had its opportunity with the Delta variant a couple of weeks ago. Got up around 93, but on the DXY, but was not able to break through. Now it looks like it's going to go back and test the 91.50 level, which is the technically important level. And so to me, that's the dollar is likely to weaken. We hold EMLC, which is the local currency EM debt vehicle, to kind of express that. I don't expect it to weaken dramatically against the majors, the yen or the euro. Euro at 118 to 120 seems like that's where it wants to be. I guess if Europe really does manifest a strong recovery, you could see that strengthen a little bit, but it's not going to go crazy. And likewise, the yen at 110. I know the Japanese companies have penciled in, I think, 106 for year-end March 2022. And so a weaker yen than that obviously helps corporate earnings, but I don't think we're going to see a dramatically stronger yen. So dollar weakness limited more to the EMFX, I believe, in the world that I see in the next 6 to 12 months. But I would be surprised if the dollar doesn't weaken as we go forward here over that next, as I say, 6 to 12 months.
Yeah, you and you also you kind of guessed my question on emerging markets, because you talked about I remember I forgot the ETF name on the local currency debt. So to wrap up, can you remind us what you like most on EM today? You talked, you had a right call way back of the traditional EMs, like Brazil, Mexico, and the commodity exporters. So what do you like most now? Is it equities based on the move to value over the next few months, or still mostly on or still the debt of local currency, or maybe there's space for both?
There is space for both, and we own both. We own both the EMLC, as I mentioned, and then also ILF for the Latin American exposure. That equity position, the equity is bigger than the debt. And we also own and hold some China exposed ETFs as well. And we've not sold them during this last couple of weeks, and think that they will continue to be fine. So, we're overweight DM versus EM. That's been our clear view, for the last year. We think the real play is in Europe and Japan more than in broad EM. We think that China now clearly has gotten much more reasonable value-wise, and so I think holding China equity at this point is probably a pretty decent risk-reward. But we like Latin America in particular because it is tied to the commodity cycle. And again, just like we've talked about a number of things, not kind of confirming traditional relationships. Latin American equity and the commodity cycle is another one that is not, been its traditional relationship. And we think part of that is, again, COVID. Part of that's the political response to COVID. But we do think that those relationships are going to reassert themselves. And, in the case of Brazil, we've been bullish on the currency. We've been bullish on the equity market. The currency did break below 5 and then, of course, has pulled back. We think it's going to go back under 5. We think rates are likely to go higher, but that's not going to be a problem for the equity market. And we continue to think Brazilian equities and Latin American equities in general, Mexican equities, Chilean, et cetera, are pretty interesting here. So, we're overweight we're overweight non-US, we're overweight DM versus EM, we're overweight Latin America versus Asia within EM equity. We continue to hold EMLC, and that would be the bulk of our equity exposure. In China, just to be clear, we own a healthcare related ETF, KURE, which we see as a growth area within China. And we think I'm likely to get significant negative government action given the importance of healthcare to an aging demographic.
So that's fantastic, and we're right at the mark. And I can't believe how much stuff we have covered. So
you really test me with these, Roberto. I'm telling you, I go home at the end of these Mondays and I'm exhausted. An hour, we go around the world.
Yeah. No, this one was a special because of the monthly, which is very good. There's a lot of stuff there. As I said, we are writing a special. We do most of the time, but we're writing a special update and send to clients tomorrow with the main takeaways. And we got people more excited for the next one. So it was great again. And look forward to see you. If I'm not wrong, it's going to be the 16th of August, right?
Yes, exactly. 2 weeks from today, we'll do it again, and we'll see what happens. I think, we'll see if poor seasonality is actually a reason to avoid the markets, or if we should do a little bit more digging and a little bit more analysis about how we want to be positioned. At least that's my bet.
I agree. I totally agree. I think now it's the time, to look and to position yourself for the not really the second half, for the post summer period.
For the turn, as I said, right, approaching the turn.
Yeah,
so like a horse race, right, or like even the Olympics, right? We're coming around the bend, we're coming around the turn, going down that straightaway. We want to be positioned to go down that straightaway, and that's where I think we really are. Right at approaching that turn. That's why I titled the monthly what I did. And this has been a great overview of what we talked about there. And welcome any interest from clients on our model portfolios, as well as our advisory work. And in the interim, we'll continue to stay very focused with them.
Well, thanks, Jay. Good to see you again, and enjoy your week.
Thank you, Roberto. Same to you. Bye-bye.